Hi and welcome to Swissquote's Daily Market Talk. It's Monday, 15th of June, and the week starts on an excellent mood as hopes for a genuine breakthrough in the Middle East lifted market sentiment after reports this weekend that the US and Iran had reached an agreement to end the conflict in the Middle East and to reopen the Strait of Hormuz. So oil prices fall sharply this Monday, easing inflation concerns and boosting global equities, while bond yields move lower on expectations that central banks around the world may face less pressure to tighten their monetary policy ahead of a week full of central bank decisions, including the Federal Reserve, the Bank of Japan, the Bank of England, the Swiss National Bank, and the Reserve Bank of Australia. So we will talk about all that and more, but before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So the Middle East could be progressing toward a concrete peace deal, and this time it could be real, as Pakistani PM announced this weekend that the US and Iran had reached an agreement to end the conflict in the Middle East and to reopen the Strait of Hormuz by Friday. Now, it was his first announcement of a peace deal versus 39 announcements of peace deal by the US President Donald Trump since the conflict began 3 months ago, according to Bloomberg. As such, there's a chance that this time is a charm, so markets are taking the news seriously. The US crude fell 4.5% in Asia this morning to $80 per barrel level. This is by far the lowest level since the first days of the Iranian war, and global equities rallied with joy, obviously. The Nikkei is up by nearly 3% today to a fresh record high at the time I'm talking here, while the Korean Kospi Index rallied more than 5%, close to a record high as well. European and US futures are deeply in the green into the European Open this morning, as the decline in oil prices could be sustainable and eventually lead to easing inflation expectations globally and to a softer monetary policy stance across major central banks. So the US 2-year yield is down to around 4% this morning, reflecting that thinking. Of course, some remain still skeptical regarding the upcoming peace deal between the US and Iran, as one, Donald Trump couldn't help himself but told New York Times on Sunday that if an agreement isn't reached on nuclear deal, the attacks would continue on Tehran. And two, Israel has gone totally out of control and nobody knows if Israel will be just stopping its attacks. But as long as oil prices remain in check, the market's perception of geopolitical concerns will continue to ease. And that's great news heading into a week full of major central bank meetings and decisions. Remember, the European Central Bank raised its interest rates last week for the very first time in almost 3 years to fight the rising inflationary pressures in the euro area, without much hope either that the latter would help easing these price pressures when oil prices are high. But today, and if oil prices ease sustainably, they could eventually achieve their goal of easing inflation without posing additional trouble to the European economies, and that's good news. On the flip side of the world, the Reserve Bank of Australia has been raising its interest rates to slow down the price pressures there. Australian policymakers are expected to sit on their hands at this week's monetary policy meeting, and we'll see how the Australian economic data evolves. The Bank of England and the Swiss National Bank in Europe are also expected to maintain their own monetary policy rates unchanged this week. But due to a complete different set of reasons, the Bank of England is actually trying to gain some time as inflation in the UK came in softer than expected by analysts in the latest print, remember, but we know that it will spike when the energy price cap will be readjusted. With a little bit of luck though, global energy prices could ease in the coming weeks to temper the price pressures in the UK and somehow reduce the need for future interest rate hikes when the economy is suffocating under the heavy weight of the country's pitiless fiscal policy. That is primarily due to the political decisions of the past that actually leaves the country and the politicians where productivity and growth remain anemic, while no other choice than to limit the government spending in a setup, remember, where investors around the world are asking an increasingly higher return to hold the increasingly risky British debt. Note that the UK's GDP contracted in April as expected. The data came in last Friday. We have quite different weather in Switzerland, however. The S&P saw the Swiss inflation rise, but rise to 0.6% only, which is well below its 2% policy target, and feels no urge whatsoever to raise the interest rate. On the contrary, watching other major central banks raise rates may help soften the Swiss franc in the coming weeks, which would be a great welcome if oil prices come down at the same time as well. Then we have two other monetary policy meetings that deserve greater attention. One, the Bank of Japan is due to announce its policy rate tomorrow, and the bank would better hike its interest rates tomorrow when the dollar yen is insistently trading above the 160 uncomfortable level, even with a broadly softer US dollar this morning across the board thanks to falling oil prices. Then there's the Fed. The Fed will announce its latest decision on Wednesday this week, and the world's most important central bank is widely expected to maintain its monetary policy unchanged at this week's meeting. But the meeting will be under very close watch. It will mark the first meeting of Kevin Warsh as FOMC's chair, and there will be a dot plot as well. Now, Kevin Warsh is taking over a divided Fed. Remember, in April, the Fed had decided to hold its interest rate steady, but that decision was based on very unusual vote split. 8-4. 4 members wanted to hike the interest rates last time. Therefore, Kevin Warsh's first accompanying statement will give the tone regarding the Federal Reserve's overall monetary policy outlook. We know that Kevin Warsh is in favor of cutting the interest rates, and with a permanent peace deal in the Middle East and a sustainable decline in oil prices, he will likely argue that the recent spike that we saw in US inflation could actually end up being temporary, maybe reopening the door for rate cuts later this year, or at least ease the worries of a late-year rate hike in the United States. And along with falling oil prices, of course, we could see this week the greenback soften against most majors. Indeed, dollar starts the week on a weaker note. The euro dollar is sharply up this morning on Middle East peace hope and a return above the 50, 100 and 200-day moving average range, which would be between 116.75 to 116.85, now looks plausible for the euro dollar. Cable, on the other hand, already surpassed its own 200-day moving average to the upside and is preparing to test its 50 and 100-day moving averages, which range between 134.70 and 134.75 levels. The outlook is more neutral in GBP US dollar, however, between 133 to 136 on potentially soft Bank of England announcement this week on improved Middle East outlook. Elsewhere in precious metals, gold and silver rebound this morning, boosted by lower yields across the globe that decrease the opportunity cost of holding the non-interest-bearing metals. Now note that both metals came off significantly lower from their January highs, but both remain significantly above their long-term bullish trend base as well, meaning that their prices are still vulnerable to global risk sentiment. Especially for gold, that means that the precious metal is not yet fully ready to claim a safe haven status back. And in equities, the SpaceX IPO on Friday went very well indeed. The stock exploded 30% higher at the open and closed the day some 20% higher, with a valuation of more than $2 trillion US. A bit stretched indeed for a company that is bleeding money today without an existing technology to turn its space dreams into reality, at least in a reasonable timeline. In comparison, Amazon, for example, which is worth around $2.5 trillion US today, made more than $700 billion US in revenue last year. So yes, the valuation doesn't make sense, but hey, SpaceX may get the funding it needs to try at least to bring this dream to reality on its investors' shoulders. So to the question, should anyone invest? I answer, well, SpaceX is not an investment in traditional terms. You don't invest to get a return back. It's more like a bet. Bet on something that could be actually very promising, explosive, but with a chance of being a flop too. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.